For 10 years, I sat in that chair. My job was not to save you money. My job was to write a policy. A policy that was profitable for the company, that passed compliance, and that you would accept. The system we used, the same one used by every major insurer, is a labyrinth of algorithms designed to categorize you, price your risk, and maximize lifetime value. To navigate it, we asked questions, and your honest answers, given in good faith, were often the very things that locked you into a higher premium for years. I worked in the industry for 10 years. There is a line between fraud and strategy, between misrepresentation and prudent financial positioning. Today, we're walking that line. I'm going to show you the 3 questions on every quote form where your standard, honest answer is what the system expects and how a slight, legal refrain can fundamentally alter the algorithm's output. The 3 questions you should never answer honestly. The algorithm and the actuary insurance is a bet. You bet you'll have a claim. They bet you won't. The premium is the price of that bet, calculated by actuaries who find statistical correlations between data points and risk. Some correlations are logical. A sports car costs more to insure than a minivan. Others are controversial, like using credit-based insurance scores. The system is not about you. It's about the category you are placed in. Your goal during a quote is not to lie. It is to present your risk profile in the most favorable light the system allows. The agent's software has preset fields, drop-downs, and checkboxes. Your answers place you in boxes. Some boxes are inexpensive, others are punitive. The agent will not tell you which is which because their guidance is constrained and their goal is closure. The magic and the tragedy of the system is its rigidity. It cannot see nuance. It cannot see that you work from home 3 days a week. It can only process the number you give it. So we begin with the most costly piece of misinformation most people volunteer. Question 1. What is your primary use and annual mileage? This is the king of all rating factors after your driving record and vehicle. The system assumes more miles equals more exposure equals more risk. A standard commute can add 20 to 40% to your premium compared to pleasure use. The agent will ask, and how many miles do you drive to work each way? Your honest answer seals your fate. The industry secret, the term pleasure use is a massively broad category. It does not mean only driven on Sundays. It means the vehicle is not used for regular commute to a fixed workplace or for business deliveries. Do you have a flexible work arrangement? Do you some days take public transport, a spouse's car, or simply not drive? Do you occasionally use the vehicle for a side hustle? The system defaults to the highest risk categorization, the strategic refrain. 1. If your commute is variable or less than 3 days a week, you often qualify for pleasure use. You are not commuting in the actuarial sense of a predictable, daily exposure. 2. For annual mileage, the system often has a low mileage discount tier, for example, under 7,500 miles per year. Do you truly drive 15,000 miles? Or is that an estimate based on a few road trips? Consider your actual weekly driving, excluding rare long trips. Shaving 3,000 to 4,000 miles off a high estimate can cross a discount threshold. The agent will not probe or suggest this. Their software will not ask, do you work from home Wednesdays and Fridays? It is your responsibility to claim the most accurate and most favorable categorization. This is not fraud. This is interpretation. Question 2. What is your current insurance limits? Coverage. This question feels like a formality. It is a psychological and financial trap. The agent asks this to perform a coverage match and to gauge your sophistication. If you answer state minimum or a low limit, you have just told them 2 things. 1, you are price sensitive, and 2, you may not understand the value of higher coverage. The industry secret: the initial quote you receive is often based on the limits you currently have, not the limits you need. The system and the agent uses your answer as an anchor. If you anchor low, all subsequent prices will be relative to that low baseline. Furthermore, disclosing your current premium gives them a target to just barely beat. The strategic refrain: 1. Do not disclose your current limits or premium. Politely decline. Say, I'd prefer to see quotes based on my needs, not my current policy. Please quote me for 100, 300, 100s, and 250, 500 to 150th liability limits. This forces the algorithm to price you as a higher tier customer from the start. The marginal cost to increase from state minimum to robust coverage is often surprisingly small, but you'll never see that if you anchor low. 2. You are shopping. You are under no obligation to provide your insurer's pricing data to their competitor. This removes their ability to engage in price anchoring and just barely beating your old rate. By refusing to answer, you reset the negotiation. You are no longer asking, can you beat this? You are asking, what is your best price for proper protection? The difference in mindset saves you from being upsold later and can reveal that good coverage is more affordable than you thought. Question 3. Have you had any recent tickets or accidents? Honesty is crucial here. Willful misrepresentation about a chargeable incident is grounds for denial of a claim. But the question is often phrased as, any accidents or violations in the last 3 to 5 years? This is where precision matters. The industry secret: insurance surcharges for tickets and accidents have strict surcharge schedules. A minor speeding ticket might be surcharged for exactly 36 months. An at-fault accident for 60 months. The surcharge drops off like a clock striking midnight on the anniversary. If your incident is 35 months old, you are still paying the full surcharge. If it's 37 months old, it may have vanished from your rating. The strategic refrain: 1. Know the exact date of the incident and the surcharge period for your state and company. 2. When asked, any in the last 3 years. If your incident was 3 years and 2 months ago, the correct technical answer is no. You are answering the question was asked. You are not obligated to volunteer. Well, there was this one thing 38 months ago. The agent's software will run a motor vehicle report (MVR) and a claims history report (CLU). These reports have the dates. If the incident falls outside the look-back period specified in the quote question, it will not be factored into the initial quote. 3. The underwriting process after you apply may still find it and could adjust the final offer, but the initial quote, the one that hooks you, will be cleaner and lower. This requires homework. But this precision is the difference between passively accepting a yes that costs you $600 a year and lawfully answering a no that reflects the insurer's own underwriting thresholds. The ethical execution: how to implement. This knowledge is power only if wielded correctly. Here is your protocol. 1. Get quotes online first. The online form is neutral. It has no tone of voice. You can thoughtfully select pleasure use, input a conservative mileage estimate, select robust coverage limits, and answer date-specific questions about your history without pressure. Secure the baseline quote. 2. If you call, script your answers. I'd like a quote for pleasure use, approximately 8,000 miles annually. I'm comparing coverage options. Please provide quotes for both 100, 300s, and 250, 500s limits. I have had no chargeable incidents within the last 36 months. This language is professional, precise, and leverages the system structure. 3. Understand the audit trail. When you finally buy a policy, the application you sign will ask these questions under penalty of rescission. Your answers there must be technically accurate to the specific phrasing. The strategic reframing happens during the shopping phase to generate a competitive baseline. The final application is a legal document. 4. The golden rule. You are optimizing within the rules of the game. You are not creating fake garages, listing non-existent safety features, or omitting a licensed driver in the household. That is fraud. This is the art of legal self-advocacy in a system designed to categorize you at the highest profitable tier. Final word: the industry runs on information asymmetry. They know how the model works. You typically do not. Your honesty has been their leverage. Your newfound precision is your counter-leverage. It is not about deceiving a person. It is about understanding a system and carefully, legally, inputting the data that commands a fairer price. The agent on the phone isn't your enemy, but they are not your financial advisor. They are a conduit for an algorithm. Your job is to learn the algorithm's language. Stop giving answers. Start giving data.